Hello, welcome to the Mychal Raynes channel. I'm Mychal Raynes. Recently we've seen a pullback in the stock market last Friday and then again on Monday. Is this a regular correction or are we entering a bear market? That's what we're going to cover today. So let's take a look. You know, it's always interesting to me when the outlook for the current year comes out and to see what everybody's saying. And I saw so many things that people were talking about, like the fundamentals are just great for this economy. We see nothing on the horizon. I heard things like, oh, you're gonna look pretty foolish if you're holding cash in 2018. And it was just almost unanimously, stock market's just gonna keep going up no matter what. Well, come to find out last week we had, you know, this big correction. It's important to take a look at this and see where we're at investment-wise and economy-wise. And let's start with the overall economy. So just because we have tax cuts doesn't mean that stocks are going to keep going up forever. The way that the price works is if there's more buyers than sellers, the price goes up. And when there's more sellers than buyers, the price will go down until it evens out, and that's how we figure out price. And this happens continuously, and I made a video on it about price movements, and it's always in flux. It's always searching for the right price. When you start hearing things like second longest bull market in history, stock market's at an all-time high, it's time to think about what the next move is. So what happens after every great run up in the stock market is the stock market crash. And the problem is, if you're always in stocks, you're going to be a victim to the crash. And it's not necessary to do that. And a lot of people will say, like, well, if the economy pulls back, I'm just going to get into put options. Well, just because you go out and buy puts or whatever you want to do, but we didn't see a lot of folks doing that on the Friday it happened, and then they had all weekend to think about it, and Monday we didn't see a lot of the talking heads doing that or advocating that, and it pulled back again. And cash has been treated like trash. You know, usually people will say like cash is king or cash is trash. Cash has been treated like trash, you know, the past few years, well, really since the Great Recession. So what I did about a year ago, a little bit over a year ago, is I started increasing my cash position, and I've been ready for an economic pullback. Now, I don't have enough cash where I need a pullback to survive, but I'm not all in stocks where I'm a victim to a stock market correction or a bear market. So what I've done with my portfolio is put myself in a position that's kind of like a win-win. This isn't the time I want to guess the market and be all in stocks when they're at an all-time high. And then, because I'm worried I'm going to make a percentage or two less if I'm holding, you know, a little bit of cash as a reserve for protection and for bad economic times. And, you know, it's important to also know, as on an investing standpoint, that you don't have to be all in one thing or all in another thing and make this concrete decision. You can have a little bit of both, whatever makes you sleep well at night. And I've been sleeping well through all this. Now, I haven't posted a video in a few weeks because my family has gotten ill, and myself included, and it's taken a while this time to get healthy. But I've been wanting to put this video out there because I see a lot of people now, they're starting to get, you know, fear has entered the market. We've had a year where we've had almost zero volatility. We didn't even have a 3% pullback last year. The price of the stock market looks like an escalator. These are all red flags for me, and this is why I've been increasing my cash position. But I'm not to the point, I feel like I'm in a comfortable balance. I'm not to the point where I'm dependent on a crash to succeed, or I'm at a point where I need the stock market to just keep going up or else I'm going to get hurt. And a lot of people will advocate and they'll say, well, if you miss out on the best 16 days in the past 20 years of the stock market, you've missed out on 8%, you'll do 8% worse, or, you know, there's different figures out there for different time horizons. But if you look at the videos on this channel, we often talk about, you know, bad times, and when bad times come, we need to be able to survive that, right? It's like, you know, just look at the Japan video where we talked about 26, 27 years of a down market. Where's their 16 days, right? Just look at the end of the 20s and the early 30s all the way through like the late 40s in this country, in the US where I live. You know, and you want your portfolio to survive that because you're worried about the best 16 days and if you have all in on stock market or not. You know, it's starting to get kind of, you start to see the foolishness that's happening with sentiment. And all sentiment is just the thoughts and the feelings and attitudes of investors and economists. And it was just perpetual bull market. So I think the better question than if we're in is this a correction or a bear market, recession or whatever, is how is your portfolio? Are you prepared to weather the storm if it is a bad market? Are you prepared to, if this is just a bump in the road, are you prepared to profit off that? Do you have some stocks? You're not all in cash? You know, and find that balance. It doesn't have to be 50-50. You know, whatever balance is comfortable for you. This way, you're not a victim to risk. And people will make the case, well, by doing this, you're going to make less percentages over a period of time. Well, no, I'm not, because I'm not always doing this. But the future is unclear, and I don't know where risk is coming from, so I don't want to be in everything that's at record highs. Just watch the video on buy low and sell high, and we go into this there. And you know, my first few videos were on recessions, and the reason I did that, 3 of my first 4 videos were on recessions. The reason I did that is because I didn't see any sentiment, I didn't see any talking heads kind of warning about the dangers of this. So it's not like I called this and I had it right, and I knew last Friday we were gonna have a crash and then Monday have another crash. But I know that I'm not gonna be able to time something like that. I don't have the skills or ability to know what day this happens, and either do the talking heads on TV, newspaper, media, you know, the guy down the street. Nobody knows these things exact, and if they did, they rapidly become the richest person in the world. So by knowing this, I think it's important when the economy is in an uncertain position to be a little bit diversified. And it doesn't have to be bull market or recession. Who is thinking about inflation? You know, we've had record low interest rate, all-time low in human history, really. Some of these countries have negative interest rates. What's the consequence of that? We're going to find out, you know, in the next few years, the consequence of these negative rates. And after the Great Recession, there was a lot of money being printed, quantitative easing, and things of that nature. Is there a chicken that comes home to roost from this? You know, we're going to find out. So, you know, something like that, maybe precious metals can help you. What I'm trying to do right now is say, the market seems a little uncertain, so I want to be a little bit everywhere. I want to be able to survive and thrive no matter what the economy throws at me, just like it did the last week, right? I want to be able to survive that, and I want to dictate the risk on my terms. If I'm just all in the stock market and I'm worried about missing out, and stock market has a correction, and now I'm getting my portfolio hurt over this, I'm at the risk, and I'm a victim to the timing of the stock market. I'm a victim to the volatility. I'm a victim to almost anything that can happen. Where if I'm a little bit diversified, I can pick and choose. I can directly go to the risk that's happening in the economy on the timing that I want, and with the amount of my portfolio I want. I'm not afraid of risk, but I want to do it on my terms. I don't want to be a victim to the day-to-day or month-to-month happenings in the economy. So I think what just happened is a big reality check for investors. about diversification, and we'll see how many folks learn the lesson from this. I know if you've been a subscriber and you've watched my videos, and you probably do yourself, own a portion of your money in cash, and that's a smart thing to do. And some folks will say, well, why not bonds? Why wouldn't you just, cash doesn't give you really a rate of return. Or look at T-bills or money markets. That's like investing in cash. Such a small rate of return. Why not be in bonds? Well, bonds can get you in a lot of trouble. First way you can get in trouble with just being in bonds, and that's the end all be all, is if the interest rate starts rising and you're in bond funds. These bonds are liquid. They're constantly buying and selling bonds. So if you have a 2% bond and the interest rates rise to 4%, nobody wants your 2% bond. You're going to have to sell it at a big discount. And that's what these funds are doing. Now let's say, oh no, I don't do those funds. I just own my bonds and we're going to write them all out until they mature, and that's the plan. Well, that's great. So you're getting, maybe you got in a little after recession, you got a 1.5% bond or a 2% bond, real low rate of return. You're probably not even outpacing inflation. And you're in bonds when interest rates are at a record low. Any kind of rise in price or any kind of rise in rates is going to wipe out the value of your bond, and holding it in an inflationary environment is going to run you in the negatives. So you're risking all this money to get such a low rate of return. Does it mean you should own no bonds? No, I don't advocate that. I'm not saying that nobody should own bonds, but don't mistake the difference between bonds and cash. And cash really performs well in these bear market environments, especially recession. That's where it shines, and we've talked at length about this. And I don't need to know exactly the day that things happen. I don't need to know the next move in the market because I'm protected. And that's what this is all about. I don't like making videos just to talk about bad things that can happen in the economy. The reason I make these videos that highlight some of the bad things is just to remind myself and others that, hey, it's not always sunshine and roses, and we need a plan B in case something comes along that can hurt us. And when you set yourself up defensively like that, you have the ability to take on risk if you choose on your terms. You have the ability to be flexible. You have the ability to sleep at night, and you have the ability to ride out the storm. Now, was this a correction, the start of a bear market, or recession? Well, the fact is it's so early, it's too early to tell. We could make a case that it was just a speed bump in the road, and the tax cuts are going to make great earnings, and the market's just going to keep on, even though it's overbought, it's just going to keep on going up for a few years. Great, we can make that case. What about having a lot of volatility and we see the market run flat for a year or two? That's definitely an option. What about if the stock market goes down because we've had such a long run? This bull market's had such a long run, it's time to make it a little more honest, and people are taking profits, and then prices go down, and selling's like fuel for a fire for more selling, and then there's margin calls, and there's people that are using leverage that are getting hurt. There's derivative markets. Some of these things can unravel. So the economy is never as rosy as advertised, and usually it's not as bad as advertised either. So I just try to keep that in my mind. Another thing is, don't be afraid to dictate on your terms what your portfolio does. You'll never be able to control the stock market. You'll never be able to control the real estate market or what precious metals do, or anything, unless you're really throwing money around. Maybe Bill Gates could affect the price short term, but you're not going to beat the economy. You're not going to outpush it or outwill it, but you can make things to your advantage. We could be a little flexible now and be in a little bit of places, and when the right opportunity comes, we're going if we choose, we're going to go right to the risk. And I'll talk about that here on this channel. I don't mind sharing that at all. That's how I invest, and that's a big reason we're making these videos here on this channel. So if you're new to this channel, feel free to go back and look at some of the videos. There's a lot of good economic and investing information, you know, in the history of these videos. And if you like them, feel free to subscribe. So that's my take on the recent pullback. It's too early to tell that it's a bear market, but I think being diversified, I have the patience to wait it out and see. We can go from there. So I hope you guys have weathered the storm well yourself, and if not, I hope you take this 10% correction to maybe reassess what you're doing with your portfolio. Take a look at your strategy and how you're approaching these markets. And if you want somebody's opinion that is going through this too, we can do it together. Subscribe to the channel. And that's going to wrap us up today for this video. Thank you.